All right, it's shortly after 12 o'clock, so I think in the interest of everyone's time, we'll go ahead and get started. Thank you all for attending our webinar today, and welcome to our presentation, The Entrepreneur's Roadmap, Legal, Tax, and Financial Considerations for Your Small Business. My name is Katie Bruno, and I am a financial planner with Maury & Quinn Wealth Partners. And I am pleased today to be with Katie French, estate planning attorney with Lamson Dugan Murray, and Jessica Thompson, accountant with Verdant Accounting. And all three of us are located right here in Omaha, Nebraska. Today, Katie French is going to kick us off with talking about setting up the right entity structure for your small business, which includes a conversation about management, liability, and documentation. And then we're going to transition to Jessica, where she's going to talk about common deductions for your business based on the entity that you've chosen and how to maximize those, and also discuss paying and compensating yourself. And then I will discuss making sure that both you and your business are properly insured, and also discuss benefit plans, which includes health insurance and retirement options. We are offering a lot of content today, and I think no matter where you are in your business, whether you're just getting started or maybe you've been in business for a few years, there should be something for you to take away from our presentation and apply to your small business. At the end of the webinar, I'll open it up for questions. There is a Q&A box on your screen. Feel free to type in the questions as we go. We will monitor them, but we will wait to respond to them until the very end, just in the event we answer a question as we go along. You, of course, can always reach out to us individually, as we'd be happy to answer any questions that you might have. And with that being said, I'll hand it over to Katie French to talk about legal considerations for your small business.
Thank you, Katie. So like she said, we're going to touch really just kind of the tip of the iceberg on most of these topics for all three of us today. But I've tried to incorporate specifically in my section, again, some topics and just things to be aware of that you should have on your checklist for your business that are both for, again, new business, maybe those considering starting another business, or those of you who are established. Again, it never hurts to give everything another look and make sure that you've been doing it correctly, or maybe there's some things you want to change. So really kind of any of these topics in and of itself could be probably an entire presentation. So again, if there's anything you have questions on, feel free to reach out to us directly because there's a lot more information out there, but we're just going to try to do a broad sweep of as much as we can here today. So what I have on this slide is a couple of legal considerations that I see as kind of the common issues that I would recommend folks make sure that they are aware of if they're starting a new business, or things to monitor even when you are an established business, because these are a lot of the areas where I see legal issues come up. And obviously a lot of these things can be sort of headed off at the pass if they are appropriately documented and dealt with in advance. So the first item I have is legal liability. As I'll kind of elaborate on further, I think a lot of folks don't understand the difference between being a legal entity and being a business, the interplay of the different types of entities that you can be legally, what that means for you tax-wise. But there are very, very few instances where I would recommend to anyone being a sole proprietor. I have a lot of people come to me and say, hey, I'm doing business just by myself, or, you know, me and my wife. I go by John Doe Plumbing, so I have a business. And, you know, yes, you have a business that you've been operating as, but do you have a legal entity at that point? No, it's just you. And so that brings with it, obviously, a lot of risk. You have no protection in that situation, both for you legally if you were to get sued for some reason, but also for your personal assets. So again, there's really a difference, even if you've given your business a name and, you know, you have a website and all those sorts of things. You know, legally you have to set up an entity to protect you, and we'll get into some of the reasons why in the next couple of points. But I bring that up because I see that a lot where people have been operating solo, but not as a legal entity, and they don't really understand the risk involved in that. And that, you know, if you're doing something and someone gets hurt, they can come after your house, or any really of your personal assets. The next bullet point I have is it a taxable entity? And again, I'll get into that a little bit more on the next slide, to kind of compare and contrast different legal entity types. But not all legal entities require filing a separate tax return. So for example, if you have an LLC, but it's just you and it's a single member LLC, legally, you are a separate entity. So you're protected and you have that bubble, if you will, around your assets. And you have that protection that you want, but you don't have to file a separate tax return. So just depending on the type of entity, depends on how you reflect that legal status when you go to file your tax returns. And I know Jessica will get into some issues with the taxes as well. The next point I have is management. Depending again on the type of entity you have, depends on the management. And we'll go into that further on the next slide. But for example, if you have an LLC, it could be managed just by the members who are in the LLC, or you can designate one person as a manager. And then for corporations, there's obviously a board of directors. Governing documents is probably one of the biggest pitfalls, I guess, if you will, that I see, as far as even if people did set up an entity correctly. Let's say you set up an LLC, maybe you did it on a legal Zoom, or maybe you did it by yourself, or maybe you even had help with an attorney. But really finalizing the entity and its liability protection for you is having governing documents. Even if it's just you, having these documents essentially show that you are respecting the formalities of a legal entity. And so that, you know, both in name and in practice, you are acting as a separate legal entity, because there is a legal premise, if you will, that's called piercing the corporate veil, which is basically if you don't follow all the rules of a separate legal entity, and it gets to the point where someone is suing you or coming after your business, they can essentially say you are not acting as a business because you haven't been following these corporate formalities and you don't have any of these documents. So the first thing, if you're going to be a new business, would be to set up with the Secretary of State. That's simple to do. There's a small fee to do that. But then also, depending on the type of entity, you're going to want basically rules for how your entity operates, which is going to be bylaws for a corporation, or an operating agreement for an LLC, or a partnership agreement for a partnership. All very similar, but essentially how your entity is going to run. It's good to have, even if it's just you, because you may bring in people later and you want to have, again, that set of rules that governs the company. Also, you very oftentimes need these sorts of documents for various authorizations. For example, for a bank, to set up a bank account, they'll probably ask for your governing documents, or to get a loan, things like that. And so a lot of people don't realize that they need these types of documents until they have a request from somebody or a financial institution like that. But again, these are very, very important, again, in making sure from a legal stance that you are actually treated as a separate business from yourself and your personal assets. Transfer of ownership, I put on there in passing, and again, that could probably be a whole discussion in itself. But within the documents that govern your entity, one thing that I always want to make sure that people have, and often they don't, is a buy-sell agreement. This is a document that is basically just like it sounds. If you want to buy or sell part of your business to typically someone within the business, what the terms would be for doing that, how it would happen, the price. But it also governs things such as death or disability, so that if, again, one of your partners or one of your members would happen to pass away earlier than planned, it dictates, you know, do you want to keep the ownership within the other existing owners? Do you want maybe that person's spouse to be involved in the business. And again, the terms for potentially buying that spouse out and things like that. So sometimes people have these things on a handshake or on the back of a napkin, but these are really key legal issues that are going to cause problems for business owners if they're not spelled out in black and white when the business owner is no longer here. Because at that point, you're dealing with, spouses or other family members who may not know what your agreement was. And so that can turn into a very big legal mess for people. Also, documents could include things like gifting, ownership interest during lifetime. I see that a lot in business succession planning, such as, father to son or father to daughter. So again, having the properly documented transfer of that ownership. And of course, always estate planning should include your business entity so that it's properly documented, not only within the company documents, but also in your plan as to, again, what you want to happen with, all of your hard work at the time you pass away. So those are kind of some topics that I think apply to maybe more businesses that are just starting, or if you're newer and you just maybe don't have all of those things. Now I'm going to get into a couple of things that are geared more towards existing businesses. Contracts, purchase orders, terms and conditions. Those types of documents I'm just sort of listing generally. There's obviously a lot more, but I often, again, have customers, businesses come to me only at the point where they're having a problem with a customer over something that they probably drafted themselves, or perhaps found documents online, or just, again, have been doing business on a handshake. Another one that I could think of would be your website and the terms and conditions on your website if you're having people order things online. But these are things that I would not advise trying to navigate yourself without legal advice, because there are certain terms that we should make sure are included in all of these documents, ultimately for your business's protection. And if those things aren't included and you just have a very bare bones agreement, which doesn't really address maybe the issue that's come up with a customer or a vendor, then it's going to just get messy as far as having to sort that out legally. Whereas if we address it up front, we can make sure that all of your documents address exactly what's going to happen if a problem comes up. So those types of things, and I'm probably leaving a number of things out, but those are the things I see most often would be independent contractor agreements, purchase orders, and then again, website terms and conditions and things like that. Again, just to make sure ultimately at the end of the day, you're protected. Nobody can come back against you. We can lace a lot of language in there that would be them waiving legal claims against you. And so again, that's really best for your business. Another thing I see that's related to that topic is always make sure you enter into agreements as your entity and not as you. What I see a lot as well is that maybe someone has a business they haven't set up yet, or they do have it set up, but they maybe forget to list the actual business on a piece of real estate they bought, or they'll just go sign something because the paperwork's not done for their company yet. And so they'll just put their individual name on a loan or something like that. Again, as I mentioned off the bat, if you sign these agreements or sign these documents as yourself, you are stepping up to any potential, repayment terms, liability. All of that is then on you personally, and it is not in the business. So if you're newer, or maybe you set up an entity after you started doing business, or even on an ongoing basis if you've been doing it for a long time, there's no reason to sign, generally these types of agreements as yourself. Obviously, personal guarantees that may be required would be sort of a separate issue. But if you're entering into an agreement on behalf of your company, you want to make sure that you are signing as whatever, officer, director, manager of the LLC that you would be, to make sure that, again, any liability you would have would be limited to what's in that entity. I threw trademark and copyright on there. That doesn't apply to everyone's business, but Here and there, we have people who need a copyright or a trademark, and that's obviously a fairly complex legal process that takes quite a bit of time. So that's something to always consider, especially if there's a business that is considering maybe franchising outside of Omaha or outside of Nebraska. That would be possibly where it would be considering getting into trademark, copyright type stuff if there's going to be a greater footprint to your business. And then finally, I have employment practices as the final bullet point. Again, that's where I see a great number of sort of friction arise in existing businesses as far as not documenting compensation agreements, bonus pools, proper documentation of hiring and firing. And we do whole presentations that are just on this bullet point. Social media with employees, how do you handle if there's maybe something posted that's not great about your business, or someone that you fired that is now maybe giving you a bad Google review or something like that. So that's obviously something that you always want to get an attorney involved in, just because if you have appropriate documents in the beginning, it's a lot easier to resolve those things amicably and quickly on the back end should something come up with an employee, as opposed to, again, trying to navigate that without any documents becomes very difficult. But the employment piece of this in and of itself is a whole, again, discussion that we could get into. And if you have any specific questions on any of those types of topics, we're happy to discuss that with you one-on-one as well. So going on to the next slide, just to sort of summarize, if you will, a lot of what I already talked about. This is kind of just a very, very brief overview, and I'm not going to go through the whole thing today, but I just sort of wanted to put on one slide comparison of the different types of entities that we most often see. So, for example, like I said, on the sole proprietor, it is not a separate taxable entity, and it's also not a separate legal entity. So again, you have that risk, you have that potential there for liability. It's just you. But also, as far as under the continuity piece of it, if it's just you, then there's not going to be a business to continue on with if you were to pass away. You could sell your assets that the business owned, but it's very difficult to sort of transition that business to somebody else, whether it's on purpose or an untimely death, if you're by yourself. And again, the exposure of the owner is wide open to the owner's personal assets. So we very, very, very rarely would ever tell anyone to be operating as a sole proprietorship. What I would say I see the most is probably an LLC. We have a lot of sole proprietors end up setting up LLCs. So it's a single member LLC. So as you can see under legal status, it is a separate entity. So legally you're protected with any assets you put in there. That's what it would be limited to if someone were to sue you. But again, under separate taxable entity, it may not be a separate taxable entity if it's just you. So you may not have to file your own tax return. Then as far as management goes, board of directors is going to be who's governing a corporation. An LLC, again, can be set up with either the manager, and it can be one or more managers, just whatever you agree to in your governing documents, or it can just be managed by the members as well. There is a column on ease of formation. I guess I wouldn't say that any of these, as far as legal setup, is more challenging than the others to do. I think a lot of these other factors and the things Jessica will talk about in her portion as well probably factor into more of what you want to set up as than really the legal ease of setting this up. Again, as I already mentioned, the sole proprietorship terminates with the death of the owner, as opposed to like the LLC. We can make that perpetual when you set it up, or we can make it for a term of years, but that's pretty rare. There are some restrictions on S corporations as far as number of shareholders, which is 100 because that's a small corporation, and as well as some certain trusts cannot be shareholders in S corporations. But again, that's for a discussion if you consider having that as your entity. And again, really the benefit to having either an LLC or an S Corp, I would say, are probably the two most common ones we see, or an LLC taxed as an S Corp. You can make that election as well to kind of combine, if you will, those two entities, is really under that owner liability section, that the liability you have is limited to your investment of what you've put in there. So assets or cash that you've put in under those entities. If you were to get sued, for example, they can't come up after your house. It's limited to what's in that entity. And then there's the transferability of ownership section. Again, most of these we can in documents state how ownership would be transferred. You can buy and sell into these entities or gift, again, ownership in these entities to other generations or to bring people in. So again, this is just to sort of give you an overview of some of these things to consider when you're trying to deal with what sort of entity you're considering or perhaps changing to a different election. And then the next slide I have, I'm not even going to get into as far as today. That's Jessica's going to go into most of the important tax things. But again, just a comparison chart so you can see some of these things if you're considering setting up a new business, to know these things ahead of time so you know how they would affect and operate your business. But with that, I will turn things over to Jessica.
Thanks, Katie. So today I'm going to talk a little bit about the tax considerations for small businesses. And there are a few things, there are kind of a lot of things actually to consider from a tax standpoint, depending on the type of business you have. But most of those are related to the deductions. And when I'm talking about business tax deductions, I could spend a whole webinar and more on just the different deductions for a business. So I'm primarily going to focus on the most commonly questioned deductions that I get from people. But if you ever wanted to talk to me about deductions, you're wondering if something's deductible, feel free to reach out to me anytime. I'm happy to answer those questions for you. And I also have a worksheet that I give quite a few business owners on just a huge listing of different expenses that you may or may not have to kind of help you think of things that might be deductible. But kind of like what Katie had said about the business entities, a lot of times I most frequently see and recommend people, especially just starting, is getting an LLC, because once you have an LLC, from a tax standpoint, I, as your tax preparer, have a lot more flexibility, whereas I can see when we're filing your taxes, if it's a single member LLC, we can choose to file on your personal return as a sole proprietor. Even though you are a legal entity, for tax purposes, we can file as a sole proprietor. Otherwise, I can look and see if some of these other deductions would pay off in the long run for you to elect to be taxed as an S corporation. And same if you have a multiple member LLC, we can either choose to be taxed as a partnership or as an S corporation. And as long as you had the LLC, that gives me flexibility to help you determine that at tax time. So some of the common deductions that specifically are affected based on your tax election for a business, whether it's sole proprietor, partnership, or S corporation, would be the QBI deduction, which is qualified business income, which is a new thing that started in 2018, and then self-employed health insurance and paying yourself. Those are the three things that are most affected by your choice of entity. So QBI is really determined based off of your income, your business entity, and your household income as well. So if you have like a spouse or anybody else that's making money, we have to factor in their income, and we have to decide if your business is a service business or not. The QBI is a very complicated deduction, but it does make a large difference. So I put that in there because it's worth having a discussion with your tax preparer around this time of year. Typically we do what we call tax projections in the fourth quarter to help businesses look and see and kind of prepare for what their tax liability might be and come up with strategies for the end of the year. So QBI is one that we look at and try to strategize for. We also will help you come up with other deductions that you might want to take advantage of before the end of the year, or we might tell you to hold off on some because if you take too many deductions, it'll affect this QBI calculation and also the next one, which is self-employed health insurance. So depending on your type of business entity, depends on how you have to factor in your self-employed health insurance. And for some businesses, if you take too many deductions, you're not going to see a benefit for that self-employed health insurance. And again, it really depends on the business entity on how that works. But the self-employed health insurance is a great deduction for a business owner, but it takes some planning, because if you have too many deductions, you might not get the benefit of that. And it's not like other deductions where it just carries over. For most businesses, if you have too many deductions, you can carry the excess over to the next year as a loss. But for self-employed health insurance, it's kind of like a use it or lose it deduction. So we like to plan as much as we can for that. And then paying yourself. Paying yourself fluctuates depending on your type of entity. So if you're a partnership or a sole proprietor, you don't pay yourself with a W-2. Like, you don't run payroll for yourself. You take distributions or guaranteed payments. You can do that as well. But for an S corporation, you have to pay yourself an actual W-2 wage where you withhold taxes and payroll taxes and all of that. And there's a fine line between overpaying yourself that way and underpaying yourself that way. And so that's something that I help people strategize on as well, is how to appropriately pay yourself and how much you should be paying yourself. So that way you're maximizing the benefits that you have available to you from each source of income. And then another big one that a lot of people have is office expenses, especially with smaller businesses where you may or may not have office rent that you pay for. Maybe you're solely operating out of your home. Maybe you kind of half and half. Maybe you have an actual office where you meet clients, but most of your operation is done out of your home office. So that also takes a little bit of strategy on how much can we deduct. And what are some of our limitations if you have an office outside of your home and a home office? There's a lot of different things that we can take advantage of when you do have a home office. Particularly, we come up with a percentage and we can deduct pretty much all of your regular household expenses at a percentage rate, but then we can do a higher rate for certain other expenses, like if you purchase any office furniture or like your home internet. All of those things can be deducted at a higher rate. Your internet would typically be 50 to 75%. And then any like office furniture or anything you spend specifically on your home office, we can also typically get away with deducting 100% of that. But that's just something we have a discussion on. One other common question I have from business owners that I did not put on here is also mileage. So your vehicle expenses, that's a big one. Standard mileage deduction versus actual really depends on your business and how much you drive and what type of car you have. So that's something that we could talk about, but regardless, you have to keep an accurate mileage log, and you could do that by keeping track of your miles in a notebook or in an Excel file or something like that. But most commonly what I see people do and what I recommend is there's a mobile app called MileIQ that's been approved by the IRS. So they generate logs for you. They send them to you monthly and annually. And if you were to ever get audited for your vehicle expenses, the IRS does accept the logs that app creates for you as appropriate documentation. So that's very handy, and it's a lot less work for people to just use that app. Again, that's called MileIQ for anybody that's interested in looking into it. It's free for a certain number of drives, and then after that you have to pay for it. And then what I tell people is that's a business expense. You're paying for a business software program, so we could deduct that expense on your tax return. Another deduction that I strategize a lot with people is depreciation. So this is something that is actually pretty confusing. So sometimes when you buy certain assets, they're not allowed to be listed as an expense. They have to be depreciated as a depreciable asset. And depending on the current tax law, depends on the rate on which you can deduct the expense. So some of them we can still deduct 100% in the year that you listed on your depreciation schedule. And some assets we have to depreciate over a certain number of years. It could be 5 years, it could be 7 years, it could be almost 40 years, depending on the asset. So sometimes that's a good thing, and sometimes it's a surprising thing. So somebody might go buy something and thinking that they're getting that full deduction in the current year, when in reality, maybe it was an asset we had to depreciate over 10 years, so you're only getting 1/10 of that expense as a deduction in the current year, and then continuing going forward from there. The reason it could be a pro or a con is because we can make certain elections. So with depreciation, if you're close to losing that self-employed health insurance deduction, for example, we could elect to depreciate over multiple years, so you still get that deduction. Or we could elect to do it all in 1 year. So in years that we're really needing deductions to reduce your tax liability, it's nice because we could use that as a tool to reduce your tax liability. In some years where we don't want as many deductions, we could depreciate it over multiple years. The time where I see it being a con is mostly when people don't realize that depreciation is a thing that you have to spread out over years. And again, they were expecting to be able to write it all off, so they weren't expecting to have as much taxable income. But again, that's just kind of where that fourth quarter projection comes into play, where you just got to talk with your tax preparer and let them know that everything that you have going on, and have a discussion about that so you can be prepared for what your tax liability might be, and if you can strategize on any of the depreciation. And then my last main thing that I wanted to talk about was retirement deduction strategies. And I know that Katie's going to talk a lot more here shortly about retirement, different retirement accounts. But that is a strategy that I really like to use, especially a lot of times, depending on the type of business, depends on what type of retirement plan you could have set up. And depending on if you have employees or not, there's pros and cons to different ones. But if we can have one set up, you typically don't have to fund it until we file your tax return, as long as you file your tax return on time. So then that also offers us flexibility, or maybe in a fourth quarter projection, we can plan ahead for how much you want to put in there as well. Because the nice thing about that is not only are you saving for your future self, but you're also getting tax savings on that. So we can strategize on, like, if you're going to have a tax bill of X amount of dollars, we could look into the different retirement accounts that you have available to you and what the maximum you could contribute to. So you could pay yourself, your future self, instead of paying the IRS. Because by putting the money in the retirement, you reduce how much you have to pay to the IRS. So there's a lot of strategies with that. Again, that can also affect what we're trying to do with your self-employed health insurance. It can affect our QBI deduction, and it can ultimately affect how much you would need to or be required to pay yourself. And it can kind of offset some of these other expenses that you might have. So all of these deductions that I talked about are pretty complicated calculations, but it's something that your tax preparer definitely is familiar with and can help you navigate. These are just honestly the most important things to think about that a lot of people forget until maybe it's a little bit too late to use those as an effective strategy, because all of these are deductions that you have available to you. It's just whether you're using them appropriately or not, and getting the most out of each one of these deductions by maximizing them and taking advantage of all of them as long as you can. So again, I kind of went over a lot here, and there's so much more when it comes to deductions for businesses. So I would encourage anybody, if you have any questions, definitely feel free to ask them at the end, or reach out to me directly, and I'd be happy to answer any specific questions related to deductions for you and your business.
All right, moving on to the financial portion of this, and I'm going to be covering insuring your business, health insurance, and retirement plans. I'm going to start with talking about insuring your business. If you are operating a business out of your home, there are some important considerations with that. All too often, I see business owners have a business in their home, and they make the mistake of assuming that their homeowner's policy is going to cover their business equipment or supplies. And in some cases it may, but it really depends on your coverage. A homeowner's policy will typically include a limit of $2,500 for business equipment. So if you have business property in your home that's worth more than that, you're going to want to look into other types of insurance. Additionally, your homeowner's policy generally doesn't offer liability coverage related to your business. So as an example, if you had a delivery person delivering business supplies, or a client that came to your home and they injured themselves while on your property, your homeowner's insurance may not cover those expenses. So a home office policy is a combination policy of a homeowner's and a business owner's policy, which I'll talk about next. But this is a policy that's going to provide additional business liability coverage. It's going to offer you business interruption coverage. So if something happened to your home and you weren't able to work, it would cover lost income or expenses for a period of time. So that's the interruption coverage. And then it also gives you the increased limits for your business property. Policies, typically they start at about $10,000 for property limits, and then the liability usually starts anywhere from $300,000 to $1 million of liability coverage. There are also commercial insurance policies called business owner policies, and these are very comprehensive in nature. They're going to cover everything from your building to your property used on and off the business premises, and extensive liability coverage. It's going to cover anything from computers to software to loss of income to your professional liability. Umbrella policies. So umbrella policies are really good for everyone to look at. Even if you're not a small business owner, you should look into having an umbrella policy, because these policies provide increased liability insurance beyond the limits that are already in your homeowners, your auto, or your renters policies. The coverage in an umbrella policy kicks in when the limits are exceeded in your other policies. So examples of times where an umbrella policy might be useful, let's say you're driving down the freeway and you cause an accident that involves multiple cars, can get rather expensive. If you own a swimming pool, or you live on a lake and own a boat, and there's a water accident, that type of thing, or maybe you're a landlord, you have you could possibly be sued by a tenant or a guest, or even just someone walking down the street. And if you hadn't had your entity set up right, the creditors can go after a variety of your assets. And that could include your home, it could include your business, and in some cases, even your retirement savings. So an umbrella policy is going to protect you, especially if you have substantial assets. And the nice thing about an umbrella policy is they're actually pretty cheap. Generally speaking, you can get about $1 million of coverage for as little as $150 to $300 a year. So the way that this would work in practice is if you had a business owner's policy, and let's say that your business owner policy had liability of $3 million, and you thought you needed more, so you purchase an umbrella policy with $5 million limit, then you actually have $8 million of liability coverage. For those who are in occupations that might be more vulnerable to professional liability, there are separate professional policies. There are malpractice insurance or errors and omission insurance, depending on the business that you're in. And examples of professions that should look into this special coverage: medicine, law, architecture, daycare, personal beauty, where you are working with people and if you make a mistake, you could potentially hurt them. Automobile coverage: if you use your personal vehicle for business, then you may want to look at a commercial auto policy. An example, if you're a painter or a caterer and you're driving places to deliver your goods and services. And then also, if you travel a lot for your business, just make sure that your personal auto coverage does cover rental cars. If you rent cars, make sure that it covers non-owned automobiles. Workers' comp: you should look at the need or consider the need for workers' comp. Even if you have only one employee, you need workers' comp. Each state is going to have its own requirement for the type of workers' comp or the amount of coverage that you need. So you'll want to work with your local insurance advisor or insurance agent. And then lastly, you should look at your need for life and disability insurance. Your individual life insurance needs may not have changed when you started your business, but the amount of insurance you have may have changed. Let's say you left a corporate job to start your own business, and then you lost your employer-sponsored coverage. You may want to make up the difference so that you're still protected for you and for your family. There could be a chance that you took on more debt or liabilities in order to develop your business, and you want to protect those. Another reason to look at your life insurance. And then key person life insurance. If you've gone into business with partners, key person life insurance is going to cover financial loss to your business if you were to lose a key person. There are several different ways and creative ways that you can really structure key person life insurance. And the purpose is that if that covered individual dies, your company is going to receive that death benefit and can keep on operating while they figure out how to take over that person's role. And then for disability insurance, it's important to consider if you have enough resources for you and your family if you can't work. Look at what's in your savings. How long is that money going to last you? Most people need disability insurance to protect a loss of income. And your ability to produce an income is an asset. This is human capital, and you should be protecting and covering that just like you would your house or your car. Moving on to health insurance. So health insurance for the self-employed and small businesses can be expensive, and it can be difficult to find. There was a study by the U.S. Department of Labor, or a statistic by the U.S. Department of Labor, that said only 54% of small businesses offered health insurance. And a small business would be considered somebody that had less than 100 employees. There was a provision in the Affordable Care Act that required employers that had at least 50 full-time employees to offer health insurance, and the health insurance had to be affordable to the employees, or those employers would pay a penalty. The Affordable Care Act also established a credit to help small employers pay for health insurance, and that was for employers that had less than 25 employees. So health insurance, if you have employees, the first place that I'd go look is the SHOP Marketplace. And this is offered through healthcare.gov, and it is specifically catered to small businesses. They offer everything from HMOs and PPOs to high deductible health plans. Now your PPOs and your HMOs, these are going to be health plans that are comprehensive. They have low deductibles. They're going to protect against pre-existing condition. The difference between the two of them, which I won't go into in too much detail here, is just whether or not you have to use a preferred provider or network and the costs associated if you choose not to. A high deductible health plan is exactly what it says. It's going to be a high deductible, and in return, you're going to have a lower monthly premium. In 2019, or 2020 actually, the IRS defined a high deductible health plan as one that had a deductible of at least $1,350, and that's for an individual. Family was $2,700. If you participate in a high deductible health plan, then you're going to have the opportunity to contribute to a health savings account. And health savings accounts are a gem, and I think Jessica would even agree with that, because they're going to offer you a triple tax advantage. You're going to contribute to the health savings account pre-tax, and then the account is going to grow tax-free or tax-deferred, and then as long as you take the money out and use it to pay for a qualified medical expense, it is tax-free. The funds in an HSA can be invested once they reach a certain dollar limit, and they also get to roll from year to year. So for those who might be familiar with a flexible spending account, employers used to offer those. Those you had to use the money in it by the end of the year or you lost it. It was kind of a use it or lose it, but a health savings account is not, and you can carry it over year to year. Also a way to save some money on your taxes at the end of the year. Again, you have to be contributing in a high deductible health plan to contribute to that HSA. And there are contribution limits. It's up to $3,500 for an individual and $7,000 for a family. And there are catch-up provisions if you're over the age of 50. A health reimbursement arrangement. This is another option for small employers or even for individual coverage. This is a plan that's going to be set up by the employer, and it's going to cover medical expenses for its employees. The employer decides how much it wants to put into the plan, and then the employee can request reimbursement for medical expenses incurred. So the employee actually has to have the expenses for the employer to have to pay. As an example, I'm on the board of a local nonprofit. We only have 2 employees, so we have a health reimbursement arrangement, and we give those employees $5,000 a year. They have access to this if they have medical expenses within the year that amount to $5,000. If they don't, it's no cost to the business. It's completely reimbursement. There are limits on that too. It's about $5,150 for an individual, $10,450 for a family. Health coverage for the self-employed with no employees. The first place that you could look at is the marketplace. The individual health insurance marketplace does offer high quality health coverage, and there are some good plans out there for people who run their own businesses, but they can be rather expensive based on your income. When you fill out the application on the marketplace, you're going to find out if you qualify for a premium tax credit or any other savings. And it's based on your household size and also on your income. I can tell you that in Nebraska, it's about $51,000 of adjusted income for an individual. So if you made more than that, you would not be eligible for any tax credits or savings. And therefore the plans can get pretty expensive. Another option is short-term limited duration insurance. Short-term meaning anywhere from 6 months to 2 years. The problem with short-term plans is that they don't always cover pre-existing conditions or certain procedures, and that is based on your medical history. Catastrophic plans. Catastrophic plans are another option for some people. There are eligibility requirements, so you'll want to double check with an insurance agent to make sure that you qualify. It's based on age and also just on financial need. Monthly premiums are are low on catastrophic plans, but that's because they have extremely high deductibles. In 2020, the minimum deductible on a catastrophic plan was $8,150. So that means you're going to pay the first $8,000 of healthcare expenses before the insurance kicks in. Once you spend that month, the insurance company will cover everything else. Some places refer to catastrophic plans as major medical expense policies, and that's because these would be designed to cover major medical events, such as the event you get in a car accident, or you have cancer or a surgery, something like that. It's an affordable way to protect you from the worst case scenario. And lastly, professional association. If you are a part of a professional trade or a membership organization, you might be eligible for group health insurance through that. These members of the group share the cost of the insurance in the same way that employees in a small business do. One that comes to my mind right now is Chiropractic Association. I know they offer group health insurance. There are some for financial advisors, just things like that. So double check if there's a professional association where you could get health insurance. Moving on to retirement options. And there is a lot of information on the next 3 pages. So if you would rather have copies of the slides, which includes all the information that Katie and Jessica shared, just reach out to us. We'd be happy to provide you a copy of the PowerPoint because we do have a lot of information and content on our slides. So there are a number of retirement options that would be available to a small business. And by being a small business owner, you're going to be in charge of your own retirement savings. And the plan that works for you is really going to depend on where you're at in your career, how much cash flow you have, and whether or not you have employees. So I'm going to go through 6 different options. No, there are a lot of other options, but these are the 6 that I commonly see with small businesses. So the first one here is a SEP IRA, or a simplified employee pension. And this is a plan where the contributions are made entirely by the employer. They are ideal for a small business, and it can be a corporation or a non-corporation, and they're very easy to set up. They have very little paperwork and very little cost involved. For the contribution limits, the employer can contribute up to 25% of an employee's compensation, or $57,000, whichever is less. So for example, if you made $100,000, 25% is $25,000. So that would be your maximum contribution, whichever one is less. If you're over the age of 50, there is a catch-up provision, which means that you can contribute a little extra. In order to be eligible for the plan, you have to be at least 21 years old. And if you're an employee and you're not the owner of the company, you'd have to have worked for the employer in 3 of the 5 previous years. One of the nice things about the contribution is that they are discretionary. So the employer can make them one year and not make them the following year. But when they do make a contribution, they have to apply the same percent to all eligible employees. So if the employer says we're going to make a 10% contribution, they make a 10% contribution to anyone that's eligible. Most of the times you see a SEP IRA used for a sole proprietor or one person, even if it's an LLC, but one person running the show. And they'll try to put as much as they can away from that for themselves. When you start to get employees, you're really prohibited from maxing out your own contributions if you don't want to max out your employee contributions. The nice thing about SEPs is that you have all the way up until you file your taxes to decide if you want to start a SEP IRA. So you could be meeting with your accountant in 2021, figure out that you had a really good year and that you need to get a tax deduction, and you could then open a SEP and put money away for 2020. A simple IRA, these are going to be designed for small businesses that have fewer than 100 employees. And this is a plan that's going to allow the employee to make their own contributions. The employee can contribute up to $13,500 of their own. There's a catch-up provision there as well. For the employer contribution, they are mandatory, and the employer has two options. The employer can either give 2% to every employee that's eligible, or they can offer a match. And a match would be that the employee has to put money away for their own retirement in order for the employer to make a contribution. And that's a 3% match. You can read on here, these have to be set up by October 1st. Anytime an employee defers money, you as an employer would have to be responsible and make sure that money gets in the plan within a timely manner. But you would be able to do your employer contribution all the way up until you file your taxes for the business. Moving on to 401ks. I've listed here two 401ks for small businesses, one person or owner only 401ks, and also a safe harbor 401k, which is meant for employers that have less than 25 employees. There are also traditional 401ks that would be meant for businesses that have more than 25 employers. So I'm not going to talk about that one today. But owner only 401ks would be good for a business where the only employee is the owner and maybe their spouse. And each person within the business can earn, has to earn less than $220,000, and that's each, to be able to have the owner only 401k. And this would be for someone that wants to put in more money than they currently can in the SEP. Because the employee can put in, you can put in $19,500 as the employee, and then the employer or the business entity can contribute another 25% of compensation. The overall contribution limit is maxed, and that includes the employee and the employer part, is maxed at $57,000. Have to be 21 to participate. Contributions are discretionary, so if you have a bad year in your business, you don't have the money to contribute, no problem, you don't have to. You can determine how much you want to contribute year to year. A safe harbor 401k is a 401k plan that allows the employee to contribute. You'll see on here under the ideal for that it says without non-discrimination testing. So 401k, traditional 401k plans have discrimination testing that makes sure employers aren't contributing more to executive level or age or job title, that type of thing, to make sure that every employee that gets to participate in the plan that should be able to. Safe harbor, because they're meant for businesses with less than 25 people, they are not subject to those rules. Contributions are the same as the owner only. One of the things here is you can have a vesting schedule attached to a safe harbor, which means the employee may not receive your contributions unless they work there for a number of years. And there's multiple different ways to structure a vesting schedule, but eligibility, when an employee is eligible, does depend on the vesting schedule that you would choose for your organization. And these plans would have to be established by the end of the employer's tax year. So if you run on a calendar year, that's December. If you run and have your fiscal year set up differently, it would follow those rules. And the last two options that I want to talk about is the profit sharing plan and then the age-weighted or comparability profit sharing plan. So profit sharing plans are retirement plans where the amount contributed is based on the company's profits. And so the contribution that's made by the employer from year to year would vary depending on how much money the business made. And there are formulas that you would use to calculate. There are a couple different options you would use to calculate how much you would contribute to each employee's plan. Most are based on compensation or a percentage of compensation. So the more your employee receives in wages, the more they would get in profit sharing. The maximum contributions are very similar to 401k plans. Same thing with a vesting schedule. If you have a vesting schedule, then eligibility requirements are based on that. You have to have the plan set up by October 1st. So age-weighted or comparability profit sharing plans, same idea, but it's custom designed to favor either older employees or a specific group of employees, which could be executive level employees, so that you can contribute more to those individuals than having to contribute to all employees. And also based on a formula that you establish at the beginning of the plan, and so it does tend to have a higher startup cost. But if you're a business owner and you'd like to be able to contribute a large amount to your retirement and maybe don't want to give as much to your employees, this would be an option for you. Designing a benefit plan. Something to keep in perspective is that your employee benefits package really is all a part of the compensation package. It's not just your wages. And as a small business, it may not be feasible for you to be able to provide those traditional benefits, health insurance, retirement plan, other insurance, right out of the get-go. But employee benefits are a big component to attracting and retaining the best talent and the right talent for your business. So I did just put on here that things that you could consider to maybe make up for, and in some ways the traditional benefits are offering some of these not so traditional benefits. And I think employees are starting to emphasize or put more emphasis on these things in general. Flexible work arrangements, whether they have a flexible schedule, maybe they have a condensed work week where they work 4 10-hour days instead of 5 8-hour days, or telecommuting. I know we're seeing a lot of that within the pandemic, and I think that more and more employees are going to prefer that going forward. Wellness programs, you could offer a gym membership, flu shots for your employees. These things are relatively low cost in the grand scheme of everything, so things to look at. Professional services, financial planning, education, mental health, legal services, offering education through professionals, giving them the ability to go to seminars or webinars to hear about and learn about these things. Social activities, maybe you're buying lunch for the office once a week, or you have a monthly team outing, things of that nature, and then concierge services or discounts, laundry, childcare. The last thing I'll say here before we wrap up is you should really use your team. If you don't have a team, build a team. You know, your job as a small business is to focus on your goods or your services that you are trying to deliver. And I know when we're starting up, we may have minimal money, and so we may not get or have some of these people on our team. I've listed just a few here, but I really am a firm believer that you need a team of advisors in your life to help guide you. And these people should be able to make recommendations to you that are customized and based on your situation. All right, I'm going to see if we have any questions. Doesn't look like we have any questions. So if that's it, I will provide you with our contact information here. Feel free to reach out to any of us individually. We're always happy to have a conversation with you about your situation. I've got our emails and our phone numbers on here for you. I do record the webinar and put it on YouTube, so if you're interested in a replay, we can do that for you, or we can always send you the slides. So thank you all for attending and taking some time out of your lunch hour today to hear from us.